What do you say to an owner that has a 3% loan and does not want to give it up? We're going to talk about that today. Stay tuned. This episode of Keeping It Real is brought to you by Real Geeks. How many homes are you going to sell this year? Do you have the right tools? Is your website turning soft leads into interested buyers? Are you spending money on leads that aren't converting? Well, Real Geeks is your solution. Find out why agents across the country choose Real Geeks as their technology partner. Real Geeks was created by an agent for agents. They pride themselves on delivering a sales and marketing solution so that you can easily generate more business. Their agent websites are fast and built for lead conversion with a smooth search experience for your visitors. Real Geeks also includes an easy-to-use agent CRM. So once a lead signs up on your website, you can track their interest and have great follow-up conversations. Real Geeks is loaded with a ton of marketing tools to nurture your leads and increase brand awareness. Visit realgeeks.com/keepingitrealpod and find out why realtors come to Real Geeks to generate more business. Again, visit realgeeks.com/keepingitrealpod. And now, onto our show. Today's episode is brought to you by Corded.io. Are you looking for agents to join your brokerage or team? Now, as a real estate recruiter, I can tell you the answer is always yes. But most agents aren't looking to move right now. So how do you know who to contact? Well, what if I were to tell you there's a recruiting and retention tool powered by artificial intelligence that shows you exactly which agents in your local market are looking to leave their brokerage right now and which agents at your own firm are also looking to leave you? Now, I've been recruiting realtors for 15 years and I've hired over 2,000 agents. I can tell you with no exaggeration, this is the tool I've been waiting for. Corded's AI looks for trends across dozens of variables for each agent in your market and shows you which agents they believe are likely to move. Not only does it do that, but Corded's AI went and visited my recruiting website and read everything I offer. So now when I'm recruiting, Corded's AI tells me exactly what to say based on that agent's needs and what my brokerage can offer. It even writes emails for me. I've never seen anything like it, and I use it every single day. Now, if you are looking to grow your brokerage, Corded.io is the best tool out there. Visit Corded.io to schedule a demo. Again, that's Corded.io. And now, onto the show. Welcome to Keeping It Real, the largest podcast made by real estate agents and for real estate agents. My name is DJ Paris. I'm your guide and host through the show. Today is our monthly series called Learn with a Lender with Christian Bachelder. I want to tell you more about Christian if you're new to our show. By the way, even if you are new to our show, if you are familiar with Bigger Pockets, you'll know Christian for sure. He and his partner, David Green. We're going to give you a little bit of background on Christian right now. But together with David Green, Christian co-founded The One Brokerage, which was deemed the fastest growing broker in the nation in 2021 and 2022, also ranked in the top 20 brokerages by funded loan volume. Christian is a UC Berkeley grad. He has a bachelor's in chemical engineering, but he hated the industry and wanted to get out of a capped earning potential. So he got into real estate with the help of a childhood family friend who had some success in the business and discovered that Christian had a knack for connecting with people and adding value to their mindsets, also their investments, as well as their journey. He's a licensed real estate agent, insurance, and mortgage broker. He regularly hosts masterminds, seminars, and webinars with real estate gurus. He teaches people everything from investing principles on how to buy your 1,000th property with a focus on what markets to target, how to find the best loans, and how to protect one's investments with insurance policies and other forms of asset protection. Christian himself has purchased 15 properties in the last 12 months. We're employing the exact same principles that he's teaching us on this podcast. He created a course for loan officers to enroll to teach the fundamentals of the sales process, how to become the best advisor possible, how to get the most out of this career path, and tips on succeeding in any market. I want everybody to give Christian and his team an opportunity on your next loan, your next client loan. Go to theonebrokerage.com, and one is the number one, so theonebrokerage.com, or find Christian online. He is everywhere, and he is often sought after by lots of organizations to speak specifically about the state of the market. He's going to do that today. And Christian, welcome back to the show.
Absolutely. Appreciate you having me. Looking forward to this one.
Yeah, I am. I'm such a big fan of you and David and what you. I tell you, you guys' name comes up all the time when I talk to anyone who's an agent, who's an investor, who obviously knows bigger pockets. Like they all know you, and so it's just it's a lot of fun to have you here. And I've had David on the show before many years ago, and that was a great episode as well. But let's talk. So we got a question from the audience that I thought was a particularly good one, and you had a really unique take on it. We were talking just a few minutes ago, but the question was I'm paraphrasing, but it was, hey, I'm an agent and I have a lot of my sellers, or my owners rather, who would like to sell but don't want to give up that 3% rate. They know they want or need to move in the next few years, but they're just not quite ready to give up. I'm in that boat. I certainly understand that pain point. I'm going to be moving in the next probably year. I'm going to be giving up that rate, but that's a voluntary thing for me because it's better for me to do that now when there's less competition. So there's maybe some logic there possibly, but certainly it's a painful thing. So I guess the question is, what would you, or the question being, what would you say to a realtor who says, hey, I've got these clients, they want to move, in the near term, but they don't want to give up the rate?
Yeah, I mean, my mind immediately goes to a couple options. I mean, the first one is the client. You have to understand that your client has a point, right?
Yeah,
That's
sure.
the biggest thing is agents get into this idea that you have to sell. You learn one thing to sell, and you have to sell it. Square peg into a round hole, so to speak, right? Like you have to sell it all the time, and it's possible. I mean, obviously, if that client needs to move, it's possible you should hear them out, right? I mean, absolutely. If you had a 3% rate, I wouldn't want to lose it either, right? I don't have any 3% rates. I refinanced out of all of mine, so I'm kind of the living proof of how to scale even through the pain points of losing good rates. But in reality, there are options that you can just talk through with your client to make sure that they understand kind of the whole the whole process, right? The first one being the equity in that property isn't locked. What I mean by that is, let's say you're living in a single family. You bought it in 2020 for 500K. It's worth 600 now. And you've paid down your mortgage a bit. Let's say you owe 400,000 on it, right? Part of that equity you can tap into. You can do things like a HELOC. You can do what we kind of in the industry call a HE loan, which is basically just a fancy word for a second mortgage. And that allows you to protect the interest rate, right? Protect your 3%, your 4%, maybe your 2%, right? Depending on when you got it. And still access some of the equity in that property. Now, there are limitations of the programs. You have to qualify and all that. But all of that aside, the fundamental idea that most people believe, hey, I have a 3% rate, but I have all this equity in this property. I talked to a guy today who's got almost a $2 million single family property in the Bay Area, and he owes 300,000 on it.
Oh,
like he's like,
amazing.
I can't refi.
Right.
I'm like, why not? He's like, well, I have a 3% rate. I won't lose that. No matter what your pitch is to me, I won't lose that. I said, cool, let's do a HELOC. And he said, what's that? Yeah. And I'm like, well, what if I could put like 500K in your pocket? He's like, I'd love that, but I'm not giving up my 3% rate. I said, you don't have to, brother. It's fine. Don't worry about it. Right. And there are options there. Now, we obviously don't want to over leverage properties. I'm not the lender that just sells loans by any means necessary. Right. Just like I don't believe realtors should sell listing properties by any means necessary. But our job as advisors and guides, so to speak, in the financial industry is to give people options. It's not to make decisions for them, right? If people understand what's in front of them, they understand, hey, I can go get some equity. Obviously, that HELOC will have a payment, right? So we don't want to over leverage. We don't want to, push it into the whether it's a rental property and you're not cash flowing, or it's a primary and you're pushing above your comfort threshold. It is an option, right? And my classic kind of workaround to people in this position is, well, keep that property at a 2.5% or 3% rate. The chances are probably pretty high that you would cash flow because your mortgage payment is so low compared to what more likely than not the rental income is for that property, right? Yep. In most markets, maybe there's some markets where people are going to, point at me and say, you're wrong. My house won't cover the mortgage. Okay. But most markets, if you have a 2.5% rate and you rent that bad boy out, it's going to cash flow, right?
Yeah, I would hope so.
So, somebody sitting on a $500,000 mortgage, maybe we go put a $100,000 HELOC on it, and now you're borrowing $600 total from that property. You have the $100,000 for your new down payment, right? And that could be purchasing a new, 10% down on $1 million property, whatever you want to do with it, right? But the average weight of that large first mortgage, $500K in this example, being at such a low rate, you don't have to sell that to move if you just moved out and converted it to a rental. Now, I know not everybody wants to be a landlord. Fair. But just strictly speaking from like the best financial advice I could give, being a landlord is worth saving your 2% rate.
100, yes,
It,
100%.
it just is. And you hear the horror stories. Oh, what if my tenants don't pay? And all the nightmares that can happen. Sure, there's ways to mitigate that with good property management and due diligence on your tenants for sure. But keeping a property where you're basically borrowing money for free.
Yeah.
Now that sounds weird, but hear me out. If that money, 500 grand, is sitting in a bank account, it's losing money. People don't see it that way because the
Right.
dollar amount doesn't go down, but it is because inflation exists.
Right.
So every year, and let's just say we're being very lenient and say inflation's 3%.
Right.
It's not, but let's just pretend
Right.
like the
Be
CPI.
nice if it was only 3%.
Yeah, let's just pretend like the CPI is accurate, right?
Right.
And I'm using term CPI as the consumer price index. That's basically how the federal government monitors inflation, but it's a very flawed tool. They basically nitpick which, they cherry pick which ones actually go into the bucket. But if your money sitting in your bank account is losing 3% in our example per year, and you have a 2.5% rate, you're borrowing other people's money for less return than their money is losing.
Right.
So that bank is really losing, giving you a 2.5% rate. Now, we're not in the business of making sure banks succeed. So you should take advantage of that if that's you, right? Like, who cares if your bank's making money? Trust me, they're doing fine, right? But if you're in a position where you're borrowing less than inflation, if inflation's 3 and you're at 2.5, even if you're at 3, even if you're par with inflation, you're basically still borrowing money for free, right? So my point there being, if you can convert that property, still realize all the benefits of real estate ownership, still realize appreciation, principal pay down. A lot of people forget appreciation of rent, right? Even though you may be able to rent it for $3,000 this month, what if it's 3,200 next year, 3,500 the year after that? Like, go back and look at what people are paying for rent in the early 2000s.
Right.
It's not what it is now. And people forget about that aspect of real estate investing, is that they just look at their property appraising. They forget about their rent appraising, right? And even though most people, especially if a realtor is pitching them like sell this house, buy a new one, you should really consider the possibility of them keeping that house, solving both problems of allowing them to hold on to the good interest rate, utilizing a HELOC to tap into the equity, buy a new house, and yes, at market rates that they are today. But as DJ led off with, there's going to be much less competition right now. So your opportunity to get a price at a lower purchase price is so significantly more than it was during COVID. And all those people with 2% rates, they paid
They overpaid
200 grand, 300 grand more than it was worth at the time, right?
Yeah.
And it was validated at that time because it's worth it because your rate's so low. And there's a case to be made there. But it kind of locks you in long term, which a lot of these people, we call it the golden handcuffs in the industry, right? Where you just feel like you can't get out. And this is a good middle ground workaround solution, right? That allows you to keep the benefit while still not completely eliminating your ability to buy new property as well. And potentially, divorces, new kids, people have to buy regardless of your rate sometimes. And if they're in that position, talk about this. It's a good conversation to have as an agent.
And if you're not having these conversations with your LO, with your lender, call Christian and his team. They will work with this out with you. They will talk to your clients. They're awesome. The other idea too, and this is probably, a more controversial thought, but it's certainly, you could make a case for it, is if you can't convert that, if you can't turn it into a rental property, like I have a condo, there's, rules around it. I probably just won't be able to do that as much as I would love to never have to sell that property no matter what. Even though I won't be living in it in a year, I would love to not sell it, but I probably will have to. But if I do, it wouldn't be the worst idea to sell it and rent for a year and just take my winnings off the table, right? It's another not terrible idea that people don't typically like to go from ownership back to rental. Like, I get it. There's a psychological sort of hurdle there, but if you're going to, like, my place has appreciated quite a bit in the last 4 years, and I don't know, if I can't find something to buy, it still might make sense to sell and take my winnings off the table. Like,
yeah.
Yeah.
It
So
could.
that,
And I mean, speaking of from somebody who rents where they live and purchases investment properties, I don't own my primary, which sounds funny. But I don't, because I choose to instead invest my capital into cash flowing real estate, right?
yeah.
I'm a huge component of real estate. For myself personally, I'm not a huge component of owning where I live, because I view that as a net loss because I can rent for cheaper, right?
Right. I always think too, it's funny when we think about our primary residence as an asset. I'm like, it's not really an asset
It's
until
not.
the day you sell it. Then it's an asset because you see actual money. Other than that, it is a money pit. That is what it is. And, there's value in owning a property. There's value there, but it is not, I don't think, and I'm sure you could argue probably both sides of this, but to see it as an asset is and I just gave myself a thumbs up for watching. That was accidental. I did not mean to do that. It's Apple stuff. But anyway, you could argue it's not an asset because it
Absolutely.
costs money and it's not generating income.
Yeah, and there's some exceptions with like house hackers, or if you buy a
Mhm.
multifamily, but that's not the vast
Totally.
majority of people, right?
Totally.
And there's still something to be said. You are still building equity over the long term. A lot of people use their home as their retirement subsidy, right? I mean,
Right.
there's absolutely a justification, and then just quality of life, right? I mean, you own your own place, you can do the renovations you want. I get both sides. Just it's more of a personal preference. I
Sure.
don't have kids. I'm not in a position where I need a bunch of space. It's so if you're in that position, obviously make the right decision for you, right? And that's something that you should be talking to your agent about, or talking to your lender about what you
Yeah.
qualify for, right?
For sure. And again, I love the fact that you own a ridiculous number of properties, and yet your primary is like, I'll just rent and I'll move when I want and I'll go where I want, and that still makes the most sense in your situation. And because you are taking the capital you would be putting in for a down payment, and you are actually putting that money to work for you, so you're
Exactly.
actually using that money to make money. And the rent, I imagine, is almost negligible. I'm guessing it's almost like it's fine because
When
everything
compared to a
else.
mortgage in my area, I live in Southern California. It's significantly different, right? I mean, my monthly payment to buy a house that I'd want to live in, probably 3 to 4 times what my rent is, right?
Amazing.
So I'm saving quite a bit. And once again, that's a personal decision. That's not something that
Sure.
I'm advising everybody to do. If
Yeah.
you got 2, 3 kids and a dog and you need a backyard and all the amenities, I get it. But it's just something to think about, especially somebody who, fresh out of college or something, get your feet under you, get your investing started. And it's possible to invest early, right? There are markets where you can invest with very small down payments.
And
Um,
I love you have a lot of great sort of retirement ideas around investing in real estate. You talked about your primary being a possible vehicle for a lot of people for their retirement, and you can actually be a lot more efficient and effective by taking money out and buying properties year over year. And you do that. You guys do that, and you are big proponents of it, and that is your retirement plan. And I love that you're doing that. And so, for example, my point with saying this, and you can go back to previous episodes or just reach out to Christian and his team. They will explain to you some of these philosophies that are truly creative and are amazingly effective, which is why Christian's such a great asset to our show. But if you're not familiar with these, you almost owe it to your clients. As a realtor, you owe it to your clients to at least have a general awareness of what this is, how this could work, and just knowing this alone will help differentiate you from most other agents. So whether or not somebody decides to buy a property every year, which Christian and his team can show them guys how to do that, it's still a cool thing to bring to a client and say, have you thought about doing this? And it's a really cool thing to do yourself, because what'll happen is, if as you start investing, you're going to attract other investors. Other
100%.
people are going to notice what you're doing, and you are going to then be able to say, oh, I can show you how to do this. And now all of a sudden you've built in business for yourself.
100%. Yeah. I mean, the best agents, I wouldn't say the best, but very good agents typically tend towards investing themselves, right? I always make the
100%.
joke,
Yes.
if you walk into a BMW dealership and your salesman is driving Mercedes,
Right.
what are
Walk
we
out.
doing,
Go to
right?
go to Mercedes.
Yeah, what are we doing? Like, if you believe in the car and you're selling it to other people, like, you should probably be driving one, right?
Yeah.
Use your employee discount or whatever you got,
Right.
right?
Well,
Uh,
and it's a significant discount as a realtor. You're saving 2.5% or
yeah,
whatever, whatever your brokerage allows you to do. But I mean, at our brokerage, you could just roll the whole thing in, and that's a huge, use that discount. So reach out to Christian and his team if you have not explored this option for yourself or for your clients. This is a great phone call to have with everyone that's a homeowner, especially people who have bought in the last 7 years. Their home value is appreciated in most cases. This
100%.
You want to at least give them an updated estimate, and say, hey, I was looking at your estimate online. I think it's actually a little inaccurate. I'm going to rerun it for you and show you what I think it's really worth. And I got a creative idea for you. Whether or not you want to do it, up to you, but I just thought I'd throw it your way. People are going to be so impressed. All right, let's also do a quick state of the market. I know rates have kind of been jumping around a bit in the last week or so. They were in the 7s. Now they're, I think, in the high 6s. And again, we don't really care so much about where rates are today, but what is going on currently with rates? Nobody has a crystal ball, but what are you sort of thinking about the future of rates right now?
Yeah, I feel like the biggest term you've heard the last few years is unprecedented, from COVID to everything that's happened since then. But financially speaking, we're in a very interesting time. Obviously, we have kind of the onslaught of tariffs happening, and whether that's a positive or negative impact long term is yet to be seen. But the markets are responding accordingly, right? The original thought was that tariffs would directly lead to inflation, right? They would directly lead to increased cost of goods, which, at least in the short term here, we haven't really seen.
Not yet.
On a macro scale yet. Now, to be fair, a lot of the tariffs have been paused, and they're just now starting to get implemented. So there may be kind of a deferred, symptom of that, so to speak. But we'll see, right? If they do prove to be inflationary, that will typically lend towards higher rates, because we need to combat that inflation back down. And the way the Fed has historically done that is by pulling the rate lever, right? And just so everybody understands, why do you drop rates or increase rates to kind of stay in line with inflation? The general idea, just kind of breaking it down in kind of layman's terms, if inflation is high, that means the price of goods are like out of control, right? Inflation is going crazy. That means, but people are still buying typically, right? When you increase rates, you retract demand, because there's less volatility of money through the market. There's less loans being given. There's less things being given to small businesses that pay their staff. It's kind of a trickle-down effect, right? When rates go up, it basically like constricts the economy. It's not a good thing. We don't like increasing rates, but you have
slows
to
everything down.
Yeah, it's a slowing down basically. We don't like doing it, but you have to, because the alternative is runaway inflation, and nobody wants to see, $49 eggs, right?
Right.
So that's what the Fed will typically do to kind of stifle inflation. Where we're at right now is the Fed believes inflation to be coming through tariffs, but has not seen it yet. So the argument is we're going to keep rates high as a precursor to stifling that inflation that may come. The counter argument is there's no inflation yet. So why are we keeping rates high, right? So the argument is, why don't we drop rates for now, and if inflation comes, we raise rates in the future. That's when you hear Trump calling Jerome Powell like a doofus and, too late Powell and all the things he likes to throw out, right? That's what he's referencing is, sure, let's drop rates, and fine, if my tariffs lead to inflation, we'll handle it then. And Jerome Powell's kind of digging his feet in. I think, depending on if this kind of maintains par for the course, I do think rates in the long term, the 1, 2, kind of 3 year range, are scheduled to come down. I think it's impossible for them not to. We owe so much money. So you guys understand the rate that is set on like the prime rate by the Fed, that dictates the amount of interest that America has to pay to their bondholders, which a lot of them are other countries. So if we drop those rates, we drop the interest payments we make, and it actually saves America as a country a lot of money, which I think that'll eventually just kind of crack the decision. It just has to, right? There's too much money on the table. Like, I think if we drop by 1%, America saves it's like $900 billion or something crazy in interest payments. It's like an unfathomable amount of money, right? But that's that. The big thing, obviously, we just had the big, beautiful bill, affectionately called, right? That did have a number of impacts specifically on real estate and investors particularly. And I want to make sure I don't let this episode go by with at least addressing it briefly. The biggest thing by far for real estate specifically is the return of 100% bonus depreciation. That came back with the big, beautiful bill. And what that means, depreciation is a hard concept to grasp. And let me see if I can explain it as well as I can. When you buy a property, or really in that manner, any asset, a car, a boat, a plane, anything, every year that you own that piece of asset, whatever it is, it gets less and less valuable. That's the idea of depreciation. When something depreciates, it's wearing away, right? Well, the American tax code has an ability for you to write off the loss that that asset is generating every year. Now, it's not like a lot of people think, oh, I'm writing it off, so like I have to go pay the depreciation man. It's not a real expense. It's a paper expense. It's just saying that this asset that I bought is worth less and less every year because it's older. It costs more to upkeep. Things break. You know, if it's a home, your HVAC goes down or your roof starts to wear away. If it's a plane, you got to repair the tires, the car, the tires, all these things. It just takes more to expense, right? And what bonus depreciation is it's a tool for investors to front load their depreciation. What I mean by that is instead of taking that yearly take, like, oh, my house is worth 10 grand less this year, and then 10 grand and 10 grand. That's the calculation of how much it's worn away. Instead, it allows you to take it all in the first year.
Yeah.
The reason why that's powerful, I'll explain the most common reason is to people who use this. Let's say you have a husband and wife. The husband is a doctor, right? High income W-2 earner, a doctor, a lawyer, an attorney, something, right? And they pay a lot in income tax. Let's say our doctor makes $400K a year and he's in California, so he's probably paying close to $200K in taxes between the state and federal. It's a lot of money. What the argument is out of that 400, if he's paying 50%, he pays $200,000 in income tax. Instead, if he took that $200,000 and went and made a down payment on $1 million property, that's 20% down on $1 million. If he cost segregated, which is the study that it's called, but really it allows you to take this depreciation in year one, he may get a $200,000, $300,000, $400,000 tax write-off from that property. To give you an idea of what these numbers could be, I bought a $1.6 million property a couple years back, and I got about a $600,000 write-off for it. So it's not like small number; it's significant. Okay, and what that does is you take that write-off, and it's only for 1 year. So the argument against depreciation is, oh, what about the next years? And sure, but hear me out. You get to take that $400,000 write-off, let's say, and that completely wipes out his income. Now, what's his taxable income? He has a $400,000 earnings from his W-2, and he has a $400,000 write-off from that property he bought.
Yeah.
Boom, in the IRS's view, you made $0, which guess what your tax rate is on $0?
Yeah.
Big fat donut, right?
Right.
So basically what he did is he pivoted the $200,000 that he would have had to pay in taxes anyways, and instead he bought a property with it. And now you have cash flow potentially. Even if you don't have cash flow, you save 200 grand in taxes. It's still a big win. But ideally you have cash flow, you have, appreciation of that property, you have somebody paying down your mortgage. It's a huge win, right? And the argument is next year you do it again. Instead of paying taxes, you buy a house, right? And you get into this process of, it goes along with our other concept of buying one house a year, where you basically buy houses with your income tax, right?
So this is an amazing opportunity for people to buy a property every year, essentially.
Yeah. Especially high W-2 income earners that have a spouse at home who doesn't work, because that spouse at home can take all of those deductions. And if you guys file jointly, which 90% of couples do, right? Her loss can count directly against his income, right? And it's a household income. You get taxed as a married couple, right? Very, very, very powerful strategy. I'm leaving some details out because there are some requirements that you have to do to actually qualify for bonus depreciation. But without getting too into the weeds, I think, it's a lot of minutia, but it is possible. And if you're interested in it, there's a lot of good CPAs that specialize in this. Talk to your agent if they're familiar with it. Talk to a lender if you're looking to finance this strategy, right? But it's I would have to say, especially with bonus depreciation being back in this bill, it is probably the most powerful investment tool available to an American citizen. And I don't really think it's close.
Is any coincidence that Trump, as a real estate developer, I don't know if he specifically pushed for this, or just curious if that's connected to the fact that he was a leverage guy, so he probably employed this strategy a lot with his own investments, I'm guessing.
100%. Yeah, when you hear Trump, or another big one is Robert Kiyosaki, right?
Sure.
The rich dad, poor dad. When
Yeah.
you hear them say, "I don't pay taxes because I'm smart,"
Yeah.
they're not smart. They're just depreciating real estate. Like, I'm not saying they're not smart. I'm just saying, like, they don't have some secret, right?
Right.
They're depreciating real estate and they're writing that off against their other income. That's how they pay no taxes. It's how everybody that you've ever heard pays no taxes.
Right. Yeah, it's
Right?
really about the only way you can do it.
It's about the only way, unless you have a business that has some fake
A lot of
expenses,
losses.
you write off everything. The true way to not actually lose money and save on taxes is depreciation. Right.
Awesome. Well, look, I think we went over a lot today. I want to talk in next time about syndication deals. That's another interesting way where people park money. They can take advantage of some of the depreciation benefits, and let somebody else handle all the management side of it. I'm curious to get your thoughts on it, because I know you probably have very strong opinions about syndication deals. These are where basically you put a pool of money together, somebody else manages, could be a commercial sort of series of parcels, and you get some additional tax benefits, and then you usually get your money back after a certain amount of time with an interest payment every month. And so I'll be curious. I want to get your thoughts on versus doing it yourself and buying properties yourself versus syndication, where it's kind of like set and forget. From a tax perspective, I'm curious to hear what your opinion of
Yeah,
those.
100%. I mean, partnership syndications definitely have their place. It probably allows you to expand your capital a little bit more, right? Especially if you partner with somebody where I'll do the work and you provide the down payment, right? Obviously, I'm always going to say be careful of who you partner with,
Sure.
because there could always be the unspokens that come along with that. But it could definitely be the right fit for the right people, right? Especially if you have a good relationship with whoever it is. Could be a fit. Just be careful. Syndications I've seen get people in a lot of trouble.
Yeah.
I've seen them be very successful as well. So
Yeah,
it's a
it's a
polar
bit risky. Well, we can chat about that next time. Again, everybody, for anyone listening right now, I want you to reach out to Christian and his team for any type of a loan product that your clients might need, whether it is a primary residence or an investment. You're going to want to go to the1brokerage.com, and the one again is a number. So the number 1brokerage.com, the one brokerage, and reach out and talk to his team. They are some of the very best and brightest in the business, which is why they're such an incredibly successful lending company. So reach out to them and give them an opportunity to earn your business for your client. And Christian, once again, thank you on behalf of our clients, our audience, which are technically, I guess you call them my clients. So thank you to our audience on behalf of Christian and myself for sticking around to the end. We appreciate you. Please tell a friend about this episode. People need to hear this. This is a great skill set builder that we're building into our podcast so that you can build that skill about understanding loan products, so that you're not just constantly saying, let me talk to my lender and get back to you, right? So these are the skills that we want to help you guys build to differentiate yourself. So please tell another agent about us. It's the best way you can help us continue to grow. We appreciate you, and we appreciate Christian, and we will see everybody next month. Thanks, Christian.
Absolutely. Happy to help.